everyone, thanks for joining. So I work on OnSite's Marketing Center of Excellence, but work with a lot of our portfolio companies around building out successful channel partnership programs. My background is in marketing as well as building out indirect revenue streams for software companies. So I'm really excited to be here today and speaking with the York Group, Harold Horgan, about building successful channels. As you all know, a strong partner program has the capacity to provide extremely efficient and effective revenue streams for your businesses that ultimately will drive net new customers as well as expand existing accounts. It all sounds well and good. The reality is that it's certainly not a magic bullet that turns on overnight. Building out a successful channel program takes a great deal of time and effort, and the bottom line is it's very difficult to get that partner flywheel up and running in a predictable way, which is why we partnered with the York Group on this webinar. So I'm very, very excited to pass the mic over to Harold Horgan, the CEO of the York Group. And just a quick reminder here that there is an open questions box on your GoToWebinar interface. Please enter your questions here throughout the webinar, and we will be sure to answer all of them when we're finished with the content. With that, passing it over to you, Harold.
Are very often the best way for software companies to build their revenues. It can be the most inexpensive and the fastest way to do it when it's done correctly. So we've been working with enterprise software, so business-to-business software companies since 1993 around channel development and go-to-market, both domestically and internationally. And over the years, we have worked with a wide range of companies. These are all companies that are sub $25 million in revenues, many of them VC funded. And these are companies from about 20 different countries around the world. And we've also worked with some of the very largest companies in the industry. And what we have found is that regardless of where the companies are based, how big or small they are, and the platform that they have the technology on, everybody wants the same thing. They want partners to sell more of their stuff. That's what it comes down to. So over the next half hour or so, I'm going to teach you everything there is to know about channel development. And when we get out of this, you will have, if you have channel partners today, you will have a very clear understanding of why it doesn't always work. If you're new to channels, I think it will give you a really good baseline understanding of what you need to do to be successful. So business is a race. Effective channels can get you to the finish line faster, and that's what it's all about. How fast can you grow your revenues and move towards that exit? Companies go through very predictable phases when they're starting with their channel. Most companies, when they're new, they've built their technology, they're doing direct sales, and they will end up with some random ad hoc partners just because. They don't make an investment in a partner program, but they'll have somebody that contacts them, or somebody knows somebody, or a customer wants to work through a channel partner that they're already using. And over time, they may end up with 5 or 10 partners, still without having a structured program in place. And they'll have 5 to 10 partners, and of those, maybe one of them, and you don't really know why, but one of them is actually producing revenues on a sustainable basis. And what companies then go through is a process of thinking, well, we've got 10 partners in different geographies, 9 of them don't perform, 1 does perform. Why are they performing? What are they doing that's different? And what are we doing that's different in supporting that partner? And from that analysis, they end up with kind of best practices. And they say, well, if we can do a better job of supporting the other 9 partners, if we ask them to do more for us, maybe we'll get better results. And they redo their channel program. They become a little bit more programmatic, more structured, and then they go out and try to re-recruit the existing partners that are not performing, and they use those systems and processes to recruit new partners. And that's when they really start to get some growth through an indirect channel. And then finally, many companies end up migrating towards a partner-centric or partner-only organization. And we've seen a real shift over the years. So Microsoft has always been partner-centric. Citrix has been partner-centric. Cisco uses a lot of partners. But now we're seeing companies like Dell that used to be only direct, and now more and more of their activity is going through indirect channels. The biggest challenge for companies, though, is to go from this unstructured program to a programmatic, sustainable, repeatable partner program. And that's what we're going to be covering today, how you do that. So why should you have a channel? If it's so difficult, why should you do it? Well, you get the multiplier effect. It's one to many. And in most cases, it's less expensive to go through channel partners than it is to set up offices and have direct salespeople. And when it's done properly, we'll come back to this a couple of times, when it's done properly, the partners will be selling to their existing customers, which means that they're shortening the sales process for the first sales, which gives you a shorter time to market, shorter time to revenues. And when it works properly, a channel program is the most cost-effective way to grow your business. The margin that you give your partner covers the customer acquisition costs, the support costs, and even if you're giving 40 to 50 points to a partner, if you're collecting 50 to 60%, and that's pretty much on a net basis, that's probably a much better margin than you're getting on your direct sales activity. So when you combine all of this, the increased revenues through the multiplier effect, the shorter time to revenues, and then the better margins, all of that will increase the value of the company much faster than you can do it on a direct basis. And that's all we really need to know. All you need to do now is go out and sign up a bunch of partners, and you can make money while you sleep, while they go out and do all that work for you. But it's not quite that easy. And Meg mentioned this in her intro. In many cases, channels don't work. And what we've seen, we've been doing this for quite a while now, and we see that the overall success rate is less than 10%. That fewer than 10% of partners actually produce revenues on a sustainable, repeatable basis. And that number is actually getting smaller. The 10% of profitable relationships today typically are relationships that have been in place for 10 or 15 years. But for newer companies going out and recruiting new partners, the success rate is even lower. And it's really remarkable when you have a $2.3 trillion technology industry worldwide, and a very large percentage of that goes through channels, that companies are accepting a 90% failure rate. There are not a lot of industries where that is acceptable. But in channels, there seems to be the perception that, well, if we go out and sign up 100, 200, 500 partners, there will be enough of those partners that actually perform that will be successful. The mismatch with partners and the lack of performance actually starts at the very beginning. When you as an ISV contact a channel partner, the channel partner has some very specific ideas of what that relationship will bring for them. And what they want out of the relationship is products that sell themselves. They want services revenues. They don't want any competition from you or other partners. They want you to drive all the lead generation, and then they want big fat margins. Now, from their perspective, that's a perfectly reasonable ask. Now, so what do you want from your partners? When you contact a partner, what you want is partners that go out and sell a ton of your stuff and never call you for support. So if we transform this into a Venn diagram to find out what the overlapping interest is, it's not so much. And this is where the problems start, because you are literally speaking different languages. You as an ISV, when you sign up a partner, whether you recruited them or they contacted you, the expectation is that they are going to go out there and do all the heavy lifting for you with very little support from you. But what the partners typically want is a single transaction. They want the margins on that, and they want to get the money from a sale, to get the services, but they don't want to make an investment in building a repeatable business model. So you have to really set the expectations up front in the initial conversations with the partner. So there are really only two basic channel models. Either they work or they don't. Either you are strategic to them and they built business processes around you, or they haven't. And so we've been doing this for about 25 years. We've worked with thousands of companies, and this was one of the biggest takeaways for us, and that is that the partners are either strategic or they're not. And if you are a portfolio product and you have any complexity in the sales process and the deployment, that is going to eat up your margin, because you always have to be involved in doing the presentations, participating in the sales process, and many times also providing technical support for the deployment. When you're strategic and they're doing 8, 10, 15, 20 transactions a year, they know how to do all of that on their own. They are self-sufficient, and that's when you get the nice margins. So when are you strategic? We found out there are three key characteristics. The first is that the partner should have a dedicated salesperson. Ideally, they provide a full-time salesperson that does nothing but your product, but the reality is that you're going to have a shared resource. But there should at least be a designated salesperson, somebody that gets comped on selling your product. If nobody within that partner organization is compensated for selling your stuff, no one's going to sell it. There should also be an activities-based marketing plan. And before you sign the contract, if they're going to be a strategic partner that you expect to drive a lot of revenue, they should commit to a monthly activities-based marketing plan where they say, yes, this is what we're going to do to build our pipeline. If they're not building a pipeline, the salesperson doesn't have anything to go and sell. And they can't build a pipeline without having a marketing program. And it doesn't really matter what they do because they all do things in a different way. Some like to bring customers in for product seminars, some like to do telesales, some like to do events, and it doesn't matter what they do as long as they do something every single month to start building that pipe for you. And then ideally, you become part of their survival toolkit. One of the things that we've found is that if you are less than 1 or 2% of somebody's revenues, even if that in absolute terms is a few $100,000, if the economy changes, a salesperson leaves, or there's a management change, you're not key to their success and they can drop you. If you drive 10, 15, 20% of their overall revenues, and that can be the margin from your product and all of the services associated with it and any pull-through revenue, then you become strategic to them. If the economy slows down, they're not going to drop you. They're going to pare away other products instead. So those are the 3 building blocks of a strategic relationship. So when you build out a network of partners, your expectation is that those partners will be working as a team, energetic, enthusiastic, all pulling in the same direction. Now, for those of you that have actually had channel partners, what you'll recognize is that the real profile of your partners is something else. There are the lazy partners. They sign a contract, but they never go out and do anything to actively sell your product. There are the ones that are proactive, but in a negative sense. They're the ones that are calling and complaining and moaning about where's my MDF, where are my leads, what are you going to do for us, but they don't do anything for you in return. And then the third category are the partners that are fun to have around. They're great to go out to dinner with, have a beer with, but again, they're not very productive. And this is where 90% of the channel partners end up. So it's really your responsibility to be a good pack leader, to provide the direction and set the expectations for channel partners. And I borrowed this from Cesar Millan, the dog whisperer. And his basic premise is that dogs need exercise, discipline, and affection in that order. Now, when you get a little puppy in the house, you tend to give them a lot of affection and then hope that they are going to behave. And Cesar Millan, his philosophy is that, well, you take that puppy out for a run for 20 or 30 minutes, and they come in and they're tired, and they're much more likely to listen to what you have to say. And then if they misbehave, you provide some discipline, and then only then do you reward them with affection. And when you look at a channel program, it's the same dynamics. When an ISV gets contacted by a channel partner in France or Germany or Dayton, Ohio, and says, we found your product, we're really interested in being your partner, the natural inclination is to say, wow, that's great. What can we do to help you? Can we provide some MDF? Can we help you in the sales process? Can we send you some leads? And you are actually providing all that affection up front. And what you're doing is you're setting a pattern of behavior that becomes almost impossible to break. So in terms of Cesar Millan's program, the exercise is having the partner do what they are supposed to do, making a commitment to do all their own marketing, to do their own sales, and to do their own customer support, and setting that expectation up front. The discipline part of it is making the relationship accountable, having quarterly business reviews, having pipelines, having annual targets. How do you monitor and measure the relationship? How do you get out of a relationship that's not doing well for you? And then and only then do you reward them with the affection. You reward them with their margin, with sales incentives, with MDF, but that's the right order to do it in. You set the expectations, they meet the expectations. If they don't, there's some form of disciplinary action, if you will, that you can take, and then you reward them. So why do you keep bad partners? And every company does, whether it's Microsoft with 400,000 partners and only 10% of them are silver and gold, or it's a small company with 5 or 6 partners, everyone keeps bad partners. And why do you do that? And we illustrate this with a story about Uncle Ned. Family takes Uncle Ned to the doctor, and the doctor says, what seems to be the problem? And the family says, oh, Uncle Ned thinks that he's the chicken. Say, well, what do you mean he thinks he's a chicken? Oh, all day long he is pecking at the ground with his nose. He's flapping his arms like they're wings. He's clucking like a chicken. He thinks he's a chicken. And the doctor asks, well, how long has this been going on? They say 3 years. And the doctor says, 3 years? Why haven't you brought him in earlier? Well, we could really use the eggs. And that's the mentality behind keeping partners that don't perform. They fit the profile, they signed up for a reason, they've got a customer base, they've got the technical skills, but they don't go out there and produce the eggs for you. And very rarely can you change their behavior. If they're not producing the eggs for you today, they probably won't do that tomorrow, and you end up with a portfolio of Uncle Neds. and that can be very expensive to maintain. So what is the one thing that partners care about? The only thing that partners care about, and you probably know the answer to this, all they care about is money. Partners today don't fall in love with the technology for the sake of the technology. What they want is an opportunity to make money. And your value proposition, the business value proposition that you take to the partners should be focused on that. And too often we see ISVs that are so proud of the technology that they build, and if they can just provide enough information to go through a 30-page slide on or a 30-slide deck on the quality of the product, the partners will fall in love with it. You have to lead with what's in it for them. Where's the margin opportunity? How does this fit in with their business? So as you're creating that value proposition, the business value proposition, you look at it from their perspective. How are they going to make money? What are all of the components in the transaction from which they're going to make money? Now, they're going to make some money on the discount that you give them, whatever that percentage is, but that's usually only one part of the equation. For many companies, the bigger equation is going to be the services that they provide, that they wrap around the technology. Is there implementation? Are they integrating with other back office systems? Is there customization? Are they building custom apps? Is there training? And you need to map this out, because when you contact a partner, they are not going to connect those dots themselves. So you map out the business opportunity, and then you look at, well, are they pulling through other things? Are they pulling through an ERP system, or is there a BI system, or is there some hardware that they're pulling through? And you design the entire transaction so that when you contact a prospective partner, you're going to them with a business proposition. You can say, we know that you are in this space. This is what our technology does, and this is how you as a partner are going to make money. And in many cases, the discount on your technology is only a small part of that overall transaction. So from that, you can define the prospect profile. You'll know what vertical markets they need to focus on. Even if you're horizontal, many of the partners are now focused on vertical markets, and you'll have a slightly different messaging for those verticals. So you want to find partners that have a sizable customer base in those vertical markets. Do they have the professional services capability and the certifications necessary to deploy your product? Are they selling other products that are similar in size, selling into the same level of an organization? They have a sales process that matches that. Where are they geographically? Is there a cluster of these vertical companies that are in the right geography? And how long is the sales cycle? Channel organizations are built around different sales DNA. Some of them are built on selling transactions in 30 to 60 days. So antivirus, firewalls, those types of products where they have a very, very short sales cycle. Other companies are set up to handle a 6 to 12-month sales cycle, but those are two completely different organizations and sales DNA, and you have to match that up when you find the partners. And then we look at how many products are they selling. If they're selling hundreds of products and they're a catalog company, they will never give you the time and attention to drive your business. If they only have 2 products, they built their entire business around 2 products, chances are you're not going to get any bandwidth from them either. So it's really important to have this profile as you go out and recruit partners. Again, this is another story that I'll explain on why. And this is a story of the optimist. And these are 2 bounty hunters from the Revolutionary War days, Hank and Frank. And they're down to their last silver dollar. And they ride into town, they get to the saloon, they sit down to spend their last silver dollar on some drinks, and the saloon owner gets into conversation with them. And when he finds out that they're bounty hunters, he says, wow, that's great, you're here at exactly the right time. And they said, well, why is that? And the saloon owner says, well, a couple of days ago, my brother was killed by some British soldiers, and I'm offering a $1,000 reward to anybody that can bring a British soldier back dead or alive. And Hank and Frank, they look at each other and say, well, this is great, it's $1,000 bucks, this is what we do, we need the money. Yep, sign us up, we'll do that. So they get on their horses and they ride out of town, and they find a poor victim, and they chase him down to the bottom of a gully. And Frank has him on the ground, tying up, ready to bring him back into town, and he feels Hank pulling his elbow. And Frank says, what? And Hank says, stop, you gotta stop. And Frank says, why? Can't stop, it's $1,000, we need the money. And Hank says, no, look up at the horizon. And up on a ridge, there were thousands of British soldiers getting ready to attack. And Frank, he looked up at that, his eyes got big, and he said, we're going to be millionaires. And again, that's part of the philosophy behind channels. That's why companies go out and sign hundreds or thousands of partners. The idea being that they're all going to go out there, and you have to be very selective. So the recruitment process is a sales process. You're asking a company to make a commitment in sales training, a sales and marketing program, provide an introduction to their customers. So you look at this from a direct sales perspective, and you have 2 major phases in a direct sales process. You generate interest, and then you get a commitment. And in the generate the interest, you define the prospect profile, you identify the prospects, you have an initial outreach to get them on the hook, then you start the follow-up process, and once you have a qualified funnel, then you go through a more serious process to qualify them, and then you want to close the deal. And that can be a product evaluation, you visit them, in the case of a reseller, you want to sign a letter of intent and the marketing plan and agree on what the business plan is going to be. Then you move on to the formal contract, and then you schedule training. And this is a 4 to 6 month process when you are targeting a market. Let's say you're going after the UK or Australia or South Africa or a foreign market. It's at least a 4 to 6 month process because it's a sales process that you have to go through. So why don't resellers sell? It's because they're portfolio companies. And most established companies have a portfolio of products that are around their specialization. And they might specialize in a vertical, or they might specialize in certain types of applications. They're strong in security or network management or ERP. But out of those 30 products, there are only 2 that drive 90% of their business. They built their business around those 2 products. And what that means is that all of the internal business processes are focused on those 2 products. Sales, marketing, admin, technical support, order processing, everything is focused on those 2 products. So when you come in the door and you want to be strategic product number 3 and not portfolio product number 30, then you have to actually change their internal business processes so that they focus on you. And only when they change those business processes do you become a strategic product for them. So let's look at a different approach to channels. Today, channel partners don't need you. 20 years ago, channel partners were all looking for new stuff. But today, channel partners have an existing business. They've got their customer base. In many cases, they have recurring revenues from managed services. They have the 2 strategic products that they focus on. They have a portfolio of other vendors that they can just bring in on certain transactions. And from their perspective, you are a risk. You have to ask yourself, why should they invest their time and money? And you look at the risk factors that they take on. There's the market risk. They spend some money on sales and marketing, and it doesn't work out. That's part of the business model. The bigger risk is that you get bought. And today, and especially as a VC-funded SaaS company, that's a very big risk for a channel partner. They spend 2 to 3 years building up the revenue base. They start to make some money on it, and then you get acquired by Microsoft or HP or Oracle or Google, and whatever preferential relationship they had with you goes out the window. And then the third level of risk for a partner is that you don't really know what you're doing. You're going to Germany and you're asking Johan to put his strategic relationships on the line, to go to Deutsche Bank, to go to BMW, whoever his or her key accounts are, and introduce you and represent you. And if you're not in a position to provide the support that Johan needs, it's his reputation and it's his relationship with BMW that he's putting on the line. So it really is a tough business model today to be a channel partner. And I'll illustrate this with another story, the three-legged pig. Farmer John goes to visit his friend Farmer Bob, and John says, "Hey Bob, what's the deal with this pig?" He says, "See this little three-legged pig that's limping around the barnyard." And Bob said, "Oh John, that is no ordinary pig. That's a very special pig. A couple of weeks ago in the middle of the night, our house started burning, and that pig came in oinking and squealing and woke us up, saved our lives, and probably the house. Just yesterday, my little boy fell into the pond, and you know that pig dove in and pulled him to safety. Now, a pig like that, you don't eat all at once." And that's the fate of the channel partners. They're expected to build up all of this value for their vendors, but at some point they're going to be consumed in one way or another. The vendor starts selling direct, or they set up more channel partners, or they get acquired. So most of the risk in this equation is taken on by the channel partners. But you're running a risk as well. You have the cost of building a partner network. There's the opportunity cost if you set up a partner in the UK and they don't sell. There's the risk that they're collecting money, but they're not paying you. It doesn't happen often, but it does happen. There's the impact on the brand if you have a non-performing partner. If you've had a non-performing partner in the UK for a couple of years, then that pollutes the brand because the competition is going to say, you know, they've been here for 2 years, but no one's bought it. So it's very risky to take on a non-strategic partner that doesn't sell your product for some period of time. And then there's the management time and the opportunity cost of managing that building and managing the network. So the approach that we're using with a lot of our clients today is they build, operate, and transfer because it addresses all of those risks. So in this model, the partner would set up a new company. So you're going to the UK and you're ABC Software. The partner would set up a new entity that they own 100%, but as just a new company that they would call ABC Software UK. That NewCo becomes the exclusive or a defined territory reseller for you. And as long as they hit their numbers, then they maintain that preference or the exclusivity. But they have to hit the numbers. If they don't hit the numbers, then you can cancel a contract and it goes away. You have a pre-negotiated repurchase of that operation. And the typical multiple is 1 to 2 times revenues depending on their growth rate. So the idea is that you set a threshold of sales where they're going to hit in years 1, 2, 3, and 4. They're going to hit 1 million, 2.5, 5, and 10 million, let's say, in recurring revenues. And then you have the right to buy them back at a pre-negotiated price, a multiple of those revenues. And when that happens, you end up with a wholly owned company subsidiary with customers, with employees. It's a very seamless transition. And the model works really well for the partner. They have to maintain the targets. They get some multiple of revenue, some sliding scale of multiple. And the growth rate is really important because your multiple as a company is also tied to your growth rate. So we've just done this with a New Jersey reseller for a Belgian client, and we have thresholds of 2.5, 5, 7.5, and 10 million. If they get to 2.5 million in recurring revenues, then they have a multiple of 1 times revenues on the buyback. If they get to 10 million, they get a 2x, but they have to do that in a 2.5-year period. And what that does, it covers all of the risks for the channel partner, because now they can build up the revenues, they can make the investments, and they focus their time and attention on driving top line revenues. So this model is good for you because you're offloading the investment to a partner, and a partner that has an existing customer base. It works because your valuation, your multiple, depending on the industry that you're in, the type of technology, could be anywhere from 8 to 15 times revenues, and you're buying back a revenue stream of 1 to 2x. The partner's now focused on driving top line revenues. They're not as concerned about what they're getting on an annual basis as an ROI. And for you, you've now had somebody else build up a subsidiary that you can take over with the customers and the employees. And there's less time and investment for you in managing a partner than there would be if you had a company-owned subsidiary that you have to get the reporting on. It works best when it's subscription revenues, because that's when you get the big multiple on the valuation. When you're VC funded, because then there's a higher expectation that there will be an exit, so it makes a lot of sense for the partner. It works when it's in strategic markets where the market is large enough to make it worthwhile, where a partner can drive $5 to $10 million in revenues. It works when the partner has a large install base, so they can get all of the initial sales from their existing customers. No one's going to be successful doing missionary selling for a new product. And it needs to be significant to the partner, and that comes to the partner size. We found that an ideal partner size for this is someone with 50 to 200 people, because then they're typically doing somewhere between $7.5 and $20 million in revenues. And if the business owner has an opportunity to walk away with 5, 10, 15, $20 million at the end of 3 or 4 years, that has a huge impact on them. And also the solution size. It works best when the solution has an ARR of 50,000 or more, because if it's a lower price point, they have to drive so many transactions to reach a meaningful revenue level that it becomes more difficult. So the more expensive the solution, the more attractive this model becomes. So this is the build, operate, and transfer. The partner builds a subsidiary, the partner operates a subsidiary, and then transfers the ownership to you based on the targets that they've reached. But again, the out for you is that they don't hit their targets. You can do targets on a quarterly basis in the first year, then you cancel the contract, and there's no really no downside to you. So I said at the top of the hour that in 30 minutes I was going to tell you just about everything you need to know about channels. And it comes down to 5 basic principles. It's not how sophisticated your program is, how sophisticated your partner portal is. It all comes down to being selective, picking the partners that are going to do the best job for you, avoiding the temptation to build up a large network of Uncle Neds. They're just going to drain your margins on a continuous basis. It's understanding the risk from the partner perspective. If you understand the risk that you're asking them to take on, it changes the dynamics of the conversation that you have with them. And it's up to you to be a good pack leader. Partners will take a lot of direction if you know the right direction to give, and if it's in their mutual interest. And then it all comes down to money. The value proposition that you're presenting to your partners should be a business case, not a technology, where you sit down and show them how, not just the BOT, but just an ongoing basis, why it's going to be relatively simple for them to extend their existing business and make more ongoing margins. And that's what channels come down to. And I think we kind of hit it on the 30-minute mark for the presentation, and I will open to questions.
Wonderful. That was really informative. Thank you so much, Harold. So to get started, if anyone does have a question, feel free to enter it now into the side panel. We do have a question coming in. What is the right margin for partners?
Okay. It depends a little bit on the type of model, but what you're asking your partners to do is to assume all of the customer acquisition costs. So if they are strategic and they're actually investing in the marketing and driving their own leads, our recommendation is that you, on an enterprise solution, is you provide the partner 50% of the first year subscription and 30% on renewals. And now 50% sounds like a lot, but if you look at your own customer acquisition cost and you look at your own P&L, you're probably running at that number or higher. And if you transfer all of that to the partner and you're transferring the customer support, then that's a reasonable margin for them to motivate them and incentivize them to go out and spend their time and money. And then drops that margin to 30% on renewal. So on an ongoing basis, you're collecting 70% of the revenues. If you have a BOT model, you're buying back the revenue stream. So the margin that you provide in the partner from a valuation perspective is almost incidental because you will be buying back the top line revenue. So whether you're providing your partner a 20%, 50%, or 60% margin on the back end doesn't really matter because you're going to be buying back 100% of the revenues.
Awesome. Thanks, Harold. The next question that is coming in is, how should we think about building out a pipeline for recruiting partners? How should we think about prioritizing the best partners for us and when?
Okay, so it is a recruitment process, and we only suggest that you do this in targeted markets. So you're not going to be able to follow this process in multiple territories, in lots and lots of territories. So you decide, where do you want to expand with the channel? It could be Canada, it could be the UK, but you say, let's say it's the UK. And then you look at how many partners would you need to get the right market coverage. So what's the addressable market in the UK? And how many market segments do you need to get that coverage? Maybe you need 5 or 6 partners. And that is building the profile. And it's really important to nail the profile so that you know which companies to identify. So you look at the size of company, the vertical markets, their technical skills, certifications, and you build that profile. And then you start out, let's say London is going to be one of those sub-markets. Then you go through a process. You can go through all of the vendors, all of the major vendors have a partner list. So Microsoft, Infor, Oracle, HP, IBM, they all have a searchable database online of the partners, and many of them have keywords. So you can go in and do that. You look at complementary technologies and who has partners, and so you start building your list. And we often end up with a list. If we're going after a target market, we end up with a list of maybe 60 to 100 companies that more or less fit that profile, and then it's a recruitment process. But the 60 to 100 companies are all companies that we would be okay with. Some of them are going to be perfect. So when we do the recruitment, we'll break that list down into 3 tiers. The A prospects, which are the ones that really fit the profile, B prospects, and C prospects. And then we'll start at the low end. We'll start with the C prospects that if we don't get them, we don't care, but we can at least test out our messaging. We can get some response, we can get some feedback, and we can fine tune our messaging as we move our way up the quality chain of prospects.
Wonderful, thank you, that's really helpful. Another question came in, if the ARR is below 50,000, does the BOT model work, or how do we fine tune the model?
That's a good question. It can still work, but it changes the sales model. So when you look at the way products are sold, then there are 3 buckets of products and sales processes. When the entire solution is less than $10,000, that includes services. But if the customer, the end user, is paying less than $10,000, then those products can only be sold through web automation and automated marketing. You can't put a direct salesperson on a $10,000 transaction. When the transaction is $50,000 and up, then it justifies putting at least an inside salesperson on it to work it. When a solution is between 10 and 50,000, it falls into kind of the distribution valley of death, because those solutions tend to be too expensive to to sell on an automated self-service basis, but they don't drive enough margin to justify having a direct salesperson. So that's the toughest part of it. If the transaction is 10, 15,000 and it's more of a self-service product, then yes, the BOT model will work, but you need to have a partner that has a really strong marketing engine and then are used to selling high volume products, because you have to drive so many more transactions. It can work in that mid-size if the product doesn't require a lot of effort in the sales process. So if it sells for 30,000, but it's a relatively easy one to explain, the value prop is very clear to an end user, and they can do some self-service provisioning through a website, then the BOT model will still work. But then you have to make sure that the addressable market is large enough to be able to get to, you need to get into 7-figure ARR to make this interesting for you and to make it interesting for the partner. So you have to look at, if the transaction is 30,000, you need the 33, 34, 35 customers to get to $1 million. To get to 5 million, you need 150 customers. Is the market large enough? Does the partner have the capacity to build out that kind of a client base?
Great, super helpful. Another question, this is a two-parter. How do you address partners who may sell against your own products? If you have a small market share in the new market and want to leverage partners to help you gain market share, but that means they might sell against you?
Yeah. So when you're new in the market, and this will sometimes happen when they're representing competing technologies, or if they're services companies that want to build out their own applications, and those relationships typically won't work out. They have to make, if they're going to be strategic, then they have to have a marketing plan. They have to hit their targets. They can't be selling against you. We found we have quite a bit of success in recruiting partners that have competitive products. So if we look at the big companies, the Oracles and the Ciscos and those companies, in just about every industry, there's going to be an 800-pound gorilla that dominates. We avoid going after their top tier partners, but there are a lot of resellers that will carry Cisco or Microsoft or HP or whatever the product happens to be, because that's what customers ask for, but they don't get any margin. So if they're in the third tier, if they're a silver or below, or they're just a registered partner, they don't get leads, they don't get margin, they don't have any financial incentive to push that product. They just carry it because they know that some customers are going to ask for that brand. And if you come in with a technology that is competitive with that incumbent, and you're offering the partner a bigger margin and a better relationship and a more personal relationship, then they will have every incentive to go to their customers or prospects with your product. Now, if the customer specifically asks for Oracle or Cisco or whatever the big competitor is, they'll have to sell that. But if the customer is just asking for certain functionality and your product meets that functionality, they will be highly motivated to position your product against whatever that name brand product is. But if it's a channel partner that is actively selling against you, because we find this very often in systems integrators, they would much rather build than buy. And if they can charge a customer 5 times as much, but they're keeping their people busy and building out the application, then they'll do that. And that's part of setting the expectations up front. You really don't want to work with companies that are doing that, not if they're going to be strategic.
Great. Awesome. Thanks, Harold. Okay, the next question I'm seeing here is, should we build out a marketing development fund, an MDF program?
Yes, that's a fairly standard part. So an MDF program is where you set aside a percentage of revenues. What we discourage, though, is paying anything up front. A lot of channel partners are hard-coded to ask for $15,000 upfront to help drive that initial marketing. But if they're going to be a strategic partner, part of the equation is that they have an existing customer base that they're going to sell to, and they don't need MDF to sell to existing customers. They should be able to get the first 2 or 3 sales from their customers. After that, having an MDF program where you set aside 3 to 5%, which is the typical ratio, 3 to 5% of their purchases to co-fund marketing initiatives, that works really well. So if they've now transacted $100,000, you've set aside $5,000, they come to you and say, well, we're going to do a dedicated booth at a trade show, or we're going to do an event, and that's going to cost us $10,000. Then they can use the $5,000 from the MDF fund to offset 50% of the cost. But the basic principles for us is that never pay MDF upfront for strategic partner that should be selling to their existing customers, and only use MDF to co-fund so that the partner is spending as much as you are, to make sure that they're spending money on marketing that's worthwhile. If you are paying 100% of an event, it doesn't cost the partner anything. They're much more likely to spend it on initiatives that don't drive the results that you want. One more thing on the MDF is that if it's a partner that has a really strong customer base and they don't really need to spend a lot of money on marketing, we encourage you to use the MDF or make it available for technical training within their organization, because the more people that are trained on your product, the more important that product becomes to the reseller.
Really helpful. Thank you. Another question. Our product is in English. Can we sell it in non-English speaking markets?
Yeah, that's an interesting one. So there are some products that you can sell in English across the world, and those tend to be technical products, systems administration, network administration. If it's the IT department at the end user that's going to use the product, then in most places in the world they're okay with English. Whenever something hits the desktop though, then and there's a user interface, then that needs to be localized. There are some markets, so they, all the English-speaking markets, but there are some markets like the Nordics and the Netherlands where a lot of business applications are still being sold in English, where you have enough of a market that's happy to do this, use a product in English to establish a foothold. But if you really want to maximize the market penetration, you will ultimately need to do the translation. So there's two levels here. There's translation and localization. Translation is just the user fields, what people see on the screen, and that's a relatively inexpensive process. Localization is if you have to change the product and the functionality to meet local requirements. This is one of the reasons ERP products are so difficult to take international, because you have tax legislation, accounting rules, business practices, where you have to have a completely different version of your product. Not just the language, but the business logic has to be customized for each market as well.
Awesome, thank you. One last question. Can we do the billing, or does it have to go through a partner?
Yeah, we see in the SaaS environment, a lot of companies want to do the billing because they're booking the top line revenues. They'll remit the Click software does that, where they do all of the billing and then they remit the discount back to the partners. Even though Click does pay 50% margin on net new logos, the most channel partners, if you're going after strategic partners that have a strong customer base, they don't want to get cut out of that. There would be, in many cases, pushback from the partners where they want to control the billing. They're typically doing billing for other vendors as well, and in many cases, they have an existing sales agreement with the customer where they will add new products to it, and they don't have to go through a new legal review. So you'll have to take that on a case-by-case basis. From your perspective as an ISV, VC funded, you want to book the top line revenues, but most good partners that have really strong relationships with their customers, they want to maintain those. They want to do the billing themselves. If it's a BOT model, it doesn't really matter because you will ultimately get the valuation on the revenues that you buy back. If it's more of a traditional partner relationship, then you'll have to look at that, but you will get pushback from the partners.
Super helpful. So we're now at 1:45. Just want to thank everyone who attended today's webinar, and anyone who is a portfolio company, please feel free to follow up and share what you learned today with your peers on the Go Network and access to your group's partner profile for an exclusive discount. Again, we will be sharing the recording at the end of the day on Insight's blog, so I'll be sending an email shortly. Thank you so much, Harold.
My pleasure.